Hello, friends. Today we're taking a look at Nike, ticker symbol NKE. We'll be looking at the performance of the stock in the past 5 years, the analyst projections. We will also be looking at the current news and the last earnings report. Then we'll look at the last 10 years of revenue, earnings, free cash flow, and book value. And we will also take a look at the debt levels, the dividend history, and try to find a fair value. Welcome to Money Talks with Martino Reyes, where we try to learn how to take care of our money, find great companies, and at great prices. If you like my content, please leave a like and a subscribe to the YouTube channel or the podcast that you found this video on. So let's get started. Nike in the past month is down almost 6%. It had a big drop after earnings on December 21st, and since then is down almost 12%, and that's part of the reason why probably a lot of you guys are looking into this stock. In the past 6 months, as you can see, they have remained flat after the big drop, and in the last year they are down. Last year they were down almost 9%. The lowest last year got somewhere around the $90. In the past 5 years, they have had a big up and down, and that's about a 45%, which is less than 10% on year over year. A couple more information about the stock. Their analysts believe that it's a buy. They're looking at a target price in the next 12 months of $126, which will be a 16%. Of course, this number, I don't think it has been updated after the recent earnings report, so take that with a grain of salt. Dividend is about $1.48 a year, which will be at these prices $1.36. For those that you know, most of you guys probably know that Nike makes athletic shoes. They not only do that, but they also have apparel and equipment. They tend to be in a lot of teams, and so yeah, that's who Nike is. Most of you guys know who it is, so I'm not gonna really try to spend too much time of them. What I would like to do before we continue is just jump into the latest news. Why did Nike had such a big dramatic drop of almost 12%? Well, actually, they dropped more, but they have recuperated. Part of the reason it has to do with their latest earnings. In the latest earnings, if you have not had time to listen to, they grew year over year about 1% on revenue. So that is has created a lot of issues, but also they forecasted for the next year approximately also a 1% growth, which will they had already forecasted somewhere between the middle single digits, which normally that means 5%. So that's a whole drop of 4%, 4 to 5%, depending upon what you're looking. A lot of the reasons that they said is because they're looking at different issues that that Greater China, Europe, and the Middle East. They're looking at an economic slowdown over there, which is something, if you're following companies from China, you may want to look into that. So yes, they projected 1% of growth for next year. Also, they talked about reducing, I think it's over here, they talked about trying to implement a $2 billion cost plan over the next 3 years, and that might include letting some people go. Looking a little bit more at the actual results in revenue, this is something that you might be interested on. So, America overall was down about 3%. Europe was up 5%. In Greater China was about 4%, which normally Greater China, that's something that a lot of companies look for a greater number of growth over there because of the population over there. So the fact that United States is negative and China was lower, that is concerning for a lot of them. When it comes to Latin America, they had a nice 8% of comparing quarters from last year to this year. And if you were to look at Converse, which they also are as part of their brand, that was 10% down on sales. So the total revenue was up about 1% on well, actually, whenever you add everything, was about 1 to 2%. So that's part of a lot of the concerns that analysts are having. When it came to the earnings itself, they beat the expectations. They did miss revenue, which is part of the problem. So they are able to create some earnings gap, but part of the issue with having a projected revenue so low is that there's so much that you can cut. There's so much that you can save in order to hit the bottom line. So that's part of what a lot of people are worried about. And that's why in the past 90 days, there has been 20 revisions down and not any revisions up. So let's jump to the 10-year results and try to calculate the fair value. But if you would like a copy of the spreadsheet that I'm about to use, you can head up to buymeacoffee.com. I have a link in the description down there. So I just wanted to let you know that is up out there. So when we're looking at the revenue per share, in the past 10 years, it has grown nicely 8%, but as you can see in the last 5 years, it has been slowing down. And now with the predictions of it slowing down, that will be something to be concerning. Normally, I would like to see, for me, a great company is a company that is growing at least 10%, 15% will be great. Earnings, when it comes to earnings, they're following very closely the revenue. So that is also another reason why when you're analyzing Nike, you're looking if they're going to be slowing down in the revenue. They're probably going to be also slowing down in the earnings. So the last 10 years, it has been 8.6, and in the 5 years, 6.4, also a slowdown. Profit margins are about at 10%, which is pretty nice. Free cash flow, they are negative in the last 5 years, and they are in the last 10 years is about 10%. Now, with some of these growth numbers, when it comes to revenue, you see that it's doing very well. Earnings tends to be a little bit cyclical, not too much. There's a couple of drops. Free cash flow seems to be a little bit harder to predict in the future. They do have also a nice free cash flow margin of 9.5. That is nice, not the best. When it comes to book value, it's a little bit also in the cyclical kind of thing. We don't have a nice growing trend over here, but in the last 10 years, it has grown 4%. In the last 5 years, it has grown almost 10%, and that is after a big decline that they had in going from 2017 to 2020. So it's pretty nice that they're heading back. They're growing against the value of the share. So a book value right now stands at $9.30. Return on invested equity is amazing, almost 40% in average in the past 5 years, and it hasn't dropped, it has maintained. Return, normally I look for a 15%. Return on asset at 15%. That's 3 times what I look for in return on asset, average in the past 5 years. And return on invested capital at 19%. That is very nice over the 15% that we like. For all of you guys who like dividend investing, we have a very nice growth of about 10 to 11%, closer to 12 to 11% year over year in the of the dividend. This is really nice. Payout is under 50% at 43%. That is a good number. So if you're a dividend investor, if you're in the or if you're in the years in which you are depending more on income instead of growth, this will be a good company to take a look at and analyze. When it comes to debt, they were doing pretty nice, pretty low debt levels, and into 2020, it grew a lot. Is this concerning? No, I wouldn't be too much concerned on the big spike on debt, because whenever we look at the debt levels divided by the 5-year average of free cash flow, they can pay it in less than 3 years. I'm normally look for less to 5 years. I know that some of you guys have other metrics. I like this metric. It just makes a little bit more sense to me that do they have enough cash? Do they generate enough cash to pay the debt? So that's how kind of I analyze it. Outstanding shares, they have a good buyback program, and I think there was some comments in the thing that they published, the earnings report, about plans for repurchasing some of these shares. They have been buying back somewhere around 1 to 2% a year. So with a couple flat years in 2020 to 2022, that's pretty nice. So let's before we jump into the financials and valuation, I just would like to make a quick disclaimer. Just remember that I am not a financial advisor. This video is for entertainment purposes only. For educational purposes, I am not a financial advisor, like I just said. So do not make any financial decisions based on my opinions. Also, if I miss anything, or if there is any comments, do you disagree with anything of my comments so far, or my valuation coming up, please just put them down in the comments below. If you have any suggestions for any stock to analyze, also put them down there. I appreciate the comments and I read all of them. So thank you very much. Let's go into the multiple valuation, the historical multiple valuations, where we take the last, in this case, we're going to take the last 5-year multiple average, medium, and then we're going to multiply it by the revenue per share, earnings per share, free cash flow per share, book value per share, and a dividend based on the 5-year average and the trailing 12 months. Whenever we do, you can see it in the video, all the different numbers. We are looking at a number somewhere between 107 to 125 as a fair value that the market has paid, so that you know the average of those two is 115, which is where they were not too long ago. So that will be kind of the fair value that the market has been willing to pay for Nike. When we do our payback time valuations, which is if we take the next, if we just receive the free cash flow for the next 15 years and we just value that, growing them at 8%, which honestly I think that's a little high if management is what they're predicting. So the free cash, the payback time will be somewhere around 82 to 89 $9. Margin of safety is whenever we discount earnings. Valuation is whenever we take the earnings, grow them at 9%, which once again, it might be a little high. Multiply them in the future for the 32.2 5-year medium PE, and it gives, in discount them back, it gives us a price somewhere around $74 to $84 of fair value. When we use Warren Buffett's owner's earnings valuation, which I don't know if this is a good for this valuation for this kind of businesses. We are looking at a price somewhere between 50 to 66, and I know that some of you guys already are like, those are very crazy numbers. So when we put everything together, a fair value will be somewhere between $95 to $106 for this company. I think that I will probably put a bigger margin of safety, but because it's a good brand, and if you are looking at holding it for a dividend or as a swing trade, so maybe you think that you can buy it, make about 15% in a swing that you think that it might recuperate in the next year or so. I will probably be looking at entering somewhere around $85, 80 to 85, which is not far away from the low from the last year. I think there's better stocks for me. I personally will not be investing in Nike. I think it's a great brand, but it's going to be having a couple of issues. Plus, I do think that there's better stocks there. I don't think it's a grow play, but like I said, if you're a dividend investor, maybe this is a brand that you will like, or like a swing trade. With that said, thank you for being with us. I hope you liked the video. Let me know what you think in the comment sections below, and I hope to see you on the next video.